All right, hello everyone, and welcome to our quarterly compliance webinar on preparing for change, the state of compliance in 2018. We do ask that anyone who has dialed in, please mute your microphone in order to eliminate any background noise during the presentation. This webinar will consist of a 55-minute presentation, followed by a 5-minute question and answer session. Please feel free to post questions in the chat box throughout the webinar, and we will either answer them as you ask or in that Q&A session. If we do not get to your question, we will follow up with you. Today's webinar is eligible for CTP recertification credits. The credit form, a copy of the deck, and the recording will all be sent via email in the next 7 business days. Today's presentation will be given by Melody Hart and Stephanie Villatoro from Strategic Treasurer. Melody Hart joined Strategic Treasurer in the fall of 2013 as a Treasury and Finance leader with global experience in consumer products, automotive, wholesale, retail, distribution, manufacturing, not-for-profit, and service consulting. Melody has a proven record in managing relationships with banks, rating agencies, vendors, and customers. She has over 20 years of global treasury experience covering a variety of organization types and has worked formally in various corporate accounting roles. Stephanie Villatoro provides clients with realistic solutions to their challenges in the context of leading and best practices. Stephanie is responsible for technical content, effective project management, and ensuring that projects are delivered on time and within budget. Stephanie has over 20 years of global treasury experience that covers a variety of organization types. She has direct experience in various industry segments, including financial services, manufacturing, government, technology, and utility industries. Welcome, Melody and Stephanie. I'll now turn the presentation over to you.
This is Stephanie. I am going to hand it over to Melody to introduce our webinar today on the topics of discussion that we are going to discuss. Melody?
Yes, I wanted to go over the topics that we're going to cover in the compliance webinar. We're going to start, first of all, with the overall compliance situation for Treasury. Then we're going to review some of the responses from our 2018 Treasury Perspective Survey. It was a detailed survey in a broad range of topics, but it did also cover compliance. Next, we'll talk about how Treasury can be proactive and prepare for the potential compliance changes in the future so they're not surprised. And then we'll provide an update on some of the compliance changes that have occurred recently. We'll end with some final thoughts. Stephanie?
Thank you so much, Melody, and welcome everyone to the webinar today. I want to first take a look at the content of an overall Treasury experience, and you can look at our chart here for that. So we all know Treasury is it's an area that touches on many parts of the company, from cash management at the various legal entities to financing to internal controls. We also deal with risk management, acquisitions, and investor relations, regulatory compliance to various systems throughout the organization, your ERP, your TMS, your risk management systems, all those different systems that they deal with. And we see that change is the norm with Treasury and not the exception. In fact, as time has progressed, the risks that existed in the past have multiplied and they've become more onerous. Corporate Treasury continues to be thinly staffed, which poses a risk, and it drives a need for greater automation in order to maintain those good controls and efficiencies within the organization. This means that there must be a technological investment by the company, and often the reality of capability or the staffing benefits may be different than the expectations, which is also another risk. There's been an increasing globalization, and that broadens Treasury's responsibility across the board. Fraud has dramatically increased over the years with much more complex schemes by criminals and very large dollar risks. So we're seeing that that increase from, when I first started Treasury and it was check fraud only that we really dealt with. Now we're dealing with very large dollar wire transfer fraud. Fraud's also been dramatically, increased complexity tends to make these risks less transparent, so they're harder to see and harder to uncover because of all the complexities within an organization. And Treasury, because of all these areas it touches, has been gaining more and more responsibilities because of the elevated internal expectations. So because of this risk landscape of Treasury and the financial industry, what we've seen is regulators have been putting in place more and more stringent regulations that's impacting the financial key players, including Treasury. Moving on to our next slide, this is a slide of calibration of attention for Treasury, especially in the regulatory area. It goes from proposed and developing regulations established for a number of years in each of the columns. The gray one there is proposed over to the blue one on the end, which is very established regulations. From the top of each column to the bottom, it shows regulations or requirements with direct impact at the top to Treasury to those with an indirect at the bottom. For instance, something with indirect impact would be regulating someone else like a bank, but the requirements imposed on the bank will impact you as a corporate. And Dodd-Frank is one of the examples of that type of regulation. If you look at the orange bar, you can see what is coming up in the future, like GDPR, Global Data Protection Regulation, which takes in effect on May 25th, protecting personal data of the UK individuals, so United Kingdom individuals, it's protection of their personal data. We don't expect the black bars on this chart to decrease or even stay the same, as governments and entities have to continually adapt to the changing landscape of the marketplace. So moving on to one of our more recent surveys of Treasury perspectives, it covered a broad array of Treasury topics, this particular survey, including compliance. One of the questions addressed was on the top economic concern for banks and for companies. Their number 2 concern for both corporates and banks was the cost of compliance, and that was 68% of corporations and 73% of banks. And as additional regulations come about, it continues to increase the cost to comply. You can see the various concerns and their weightings on the right, with the blue bars being banks and the green ones are corporates. They range from increased cyber fraud, which, by the way, is the number 1 for both banks and corporates, compared to the others that are right behind it, which is the housing bubble, the Brexit, and trade restrictions. All of these different items compose risks for both companies and banks. So what's happening with these increased risks and increased oversight is that expectations for compliance are elevated. This burden of compliance requirements on the financial environment has become increasingly stringent, particularly on banks, but also for corporates. Only 2% of corporates believed that the compliance environment was less restrictive, and 59% believe that current compliance requirements are larger or significantly larger than historically. By contrast, not one single bank respondent saw today's compliance environment less restrictive. We see 75% saw today's environment as more restrictive. This is not unexpected since banks are much more highly regulated. So I'm going to hand it over to Melody now to talk about keeping abreast of updates.
So let's talk about the normal process for addressing change in compliance. Then we'll work this into the framework for the leading practices in compliance. The first barrier is to keep abreast of changes. The dilemma for Treasury is that often changes are not even publicly announced, or some can appear to affect banks, but it turns out they have a downstream effect on companies. And while there's a 1 to 2 year transitional phase to implement new regulations and standards, these may not be readily evident to corporations. So new regulations can be released suddenly as well and have a short time frame to implement. Some, like Section 385, although they had a time frame to implement, they can require additional programming to be done to comply with it. So how do you ensure your treasury is not caught in a rush effort to determine what must be done to comply? As this workflow shows, first you need to hear about the change. You have to research it. You have to figure out how it impacts your company. You may have to research who within your company may be impacted, even if Treasury is not, because one shouldn't assume that other areas of the company are aware of regulatory changes. So, for instance, if you look at GDPR, it will affect more than Treasury. It'll affect HR and other areas. So if you know of one change, it is important that you bring it to their attention if it's going to affect another department. Point out the impact, talk about what's needed to comply, and work with that department to implement. This may affect Treasury, but the GDPR will certainly affect HR and other areas. And many other regulations would be like that as well. You need to be sure of what your timeline is to comply and determine a game plan. But these things are done when one hears of the change at first. It's often late in the game and can cause issues with meeting the deadlines. So the reactive approach often results in a race against time to implement, and that's because of being caught by surprise and the requirements being identified late. And that's especially true with indirect impacts like Dodd-Frank. A leading practice is to use a proactive approach. If you lay out a game plan where Treasury is aware of upcoming developments and researches those changes, perhaps even anticipates potential regulations, and gets a head start on implementation when the time comes. Planning ahead puts Treasury at an advantage and demonstrates sound strategy. Let's try our polling question here, our first polling question. Okay, this one, go ahead. What represents your approach to dealing with new regulatory changes? So let's see the responses coming in.
So the different options are, we are typically caught off guard by compliance updates. Depending on the regulation, we may be caught off guard or have some forewarning. The third one is we conduct enough research to have a fairly good idea of what updates to expect, and we conduct regular research or have a game plan. So we'll wait a minute, Melody, to give everyone time. So what do you think? Do you think that third one's going to survive at the top, or see the second one coming in close behind?
Looks to me like the middle two are the ones that are getting the most votes, and the bottom one, having the game plan, is a smaller amount, but it's certainly more than the first option of being caught off guard all the time.
Yeah, I'm very glad to see that not many companies are caught off guard, and that everyone has some type of forewarning or have a good idea. And those few at the top, which we always see that little bell curve, have a game plan and they're very prepared for compliance changes. I expect that to be companies that probably already have a process in place, which we'll be talking about a little bit later. But yes, I do see most people fall in the middle category, which I do expect.
Yeah. Yeah, they did. And it's actually good to see that the ones who have a fairly good idea of what updates to do research is higher than the ones that we may be caught off guard. Mm-hmm. So that's good. It looks like there's a fairly good response, and I think, as you said, the ones who are the 17% who conduct regular research and have a game plan, those are the ones that are prepared and doing leading practices most likely. Okay, we can end the poll here, I think. So like a football team, it maintains a playbook, and they lay out various different reactions and plays so that they can draw from when they're under pressure and not have to invent a play while under pressure. So Treasury can put in place a similar framework. In essence, you're setting up a game plan with predetermined processes, predetermined escalation, controls to address abrupt or unanticipated changes. Without a game plan, Treasury has to work under a crunch and may not be able to adequately address the issues in a timely fashion. So while you may not always know ahead of time what regulations are set to be introduced, developing a game plan to respond to changes will help to provide solid, diligent, streamlined processes for new requirements. So the first thing is to establish who should be involved. And we would recommend that you establish a compliance monitoring group. And you would divvy up, assign to individuals monitoring of specific areas. So that maybe one monitors bank regulations that could impact the company, and they see a bank regulation that's coming up through their research. They go and talk to the banks because it could be that it's a bank regulation that could have a downstream effect. They investigate if it does, what things could be done to mitigate it. Another person might be in charge of FBAR or something else, and they might have multiple things in how you divvy it up. Then quarterly, the compliance team can meet to provide updates, or they can meet sooner if there's a change coming up. The committee would be responsible for implementing the changes and drawing in the proper people into the group. So if it was a GDPR, they would realize ahead of time, okay, I have to draw on HR because I know that they have contact information for UK and Europe people who fall under that regulation. And during the quarterly meetings, they should not only update on changes, but also the status of the current compliance programs, if there's any issues, etc. It is important to speak to outsiders like banks to determine indirect impact. And then you should also look at, you should also contact peers for advice as well. And another option too is looking at outsourcing or doing it internally. If you know of someone who outsources some form of compliance and a new form of compliance is coming about, you might want to reach out to those and see are they going to add to their compliance products. So once you've heard of a change, you have to understand it. You have to identify, does it impact you? Does it impact the department within the company? Is there an indirect impact? Is your bank impacted? And if it is, what are the potential changes they'll make to their businesses and processes that could affect you? So during this process of understanding the changes, you're going to have to consult with your legal team and with risk to identify if the regulation creates some exposure for the company, so you can determine how to structure the program. The spectrum of structures could be minor. It could require huge changes, like changes in systems or processes, changes in fund allocations or services purchased or credit. In the process of understanding the changes and structuring compliance, often the processes that exist will need to be mapped in the systems and the architecture. Then you can begin to identify the changes needed in the process, systems, or personnel for complying with new requirements and then mapping them to the existing structure. It's an important time-consuming effort, not one that should be rushed. Stephanie? One of the challenges for Treasury is to raise internal awareness. So many regulatory changes impact other parties, such as other departments. It's important to raise the awareness of management and executives so they understand the risks and requirements and don't discount the importance. For complicated or large companies, there could be changes in infrastructure, policies, or procedures. So an invitation is also important to notify and educate employees on the changes. Allow time for comments and revision to obtain buy-in to the processes. While legal and risk will be involved as the regulation impacts finance and Treasury, it's really important that Treasury manage the implementation of the process, as they have a broad understanding of operations and processes within companies, since they touch so many parts of the company. They touch often the manufacturing facilities and distribution facilities. They touch the payroll processes, very many processes they touch, and so they are, Treasury is best positioned to manage that process. Now, while these steps are done in each case, pardon me?
Sorry, Melody, while you're talking about that, I realized we skipped the next poll. So if you want to introduce that when you're finished, that would be great.
Okay, I will. So when these steps are done in each case of a new or changing regulation, a leading practice is to put in place a regulatory framework to address changes on an ongoing basis. So let's go to our next polling question. What areas of compliance represent the largest challenge for your firm? And the options are staying updated with all regulatory changes and updates, ongoing cost of managing the compliance, challenge of updating policies and procedures, or the time spent managing compliance on a daily basis. So where do you think we'll shake out, Stephanie?
Looks like that first and third is kind of neck and neck. So staying abreast, kind of staying updated, or that first one goes in line with our last poll question of the first two, so that they're at risk or they're falling short on a few of the regulations, of keeping abreast of them and being able to react quickly enough. So I think staying updated with those has to do with that. And that third one, that challenge of updating policies and procedures to stay updated, is complementary. It's a challenge in your day-to-day operations of Treasury, is just trying to keep up. When you add something new to the mix and have to add in policies and procedures, that's the challenge. I think that's a challenge across organizations, not just a particular one.
Okay. End the poll. Okay. Okay, so going on with some of the other steps for a game plan is you should also identify when escalation could be needed, who might be involved in the escalation process, and when you would designate that escalation should happen, and establish time frames for that escalation. You'll have to have the relevant people identified, and you need a feedback loop on this. One of the steps of implementation planning is to map the current processes. Now, one of the things I would say as part of the game plan is you should be mapping your current processes now, because you know them. You don't have to wait till there's some change to map them. If you map your processes now, at the beginning when you're putting together your game plan, you'll have them. Now you'll have to update them if they're needed. But then when you get to the point of having to implement something, you can go in and just add to the process and show where the differences are, so that you will have updated your process. And that's a great time saver, because mapping processes takes time, and updating them takes time. So if it's already mapped, only the changes are going to be what you're going to have to map. And that's a huge time saver during implementation. When you're implementing a regulation, that can really save time and help you meet your deadline. You also have to have in your playbook where checkpoints should occur, where your milestones are. You have to also specify, okay, how often is our meeting cadence during an implementation? Is it going to be decided at the time? Is it going to be weekly? Is it going to be monthly? And what your milestones are. So, obviously a milestone could be some of these items, because you can do these things all up front. When you think about it, there are so many things that can be determined up front before an issue arises. For instance, the proactive process used in FP&A areas will identify what actions would need to be taken if the company encounters a downturn. This was done during the 2000s, early, like 2008 and stuff. Companies would actually plan for if the economy got worse, what they would have to do. Well, this is not different. You can determine who the players are for various types of items that can be regulated. You can determine what external resources could be used. You can identify companies providing outsourcing. You can, who might be able to accommodate new regulations. You can determine your meeting cadence. You can determine who to assign for various monitoring tasks, how to communicate issues, and what the escalation process is. So once a new regulation is on the horizon, your team is aware of it. They've been monitoring it. They're aware of it. They've researched it, and you've begun your implementation meetings and developed a game plan so you can more easily get to the finish line on it. So those
Melody, I apologize, Melody. I was just going to add to this a little bit, so just on the importance of planning when it comes to project management of regulations. So you mentioned about on this number 6 here, mapping the current processes, develop an implementation approach. And one of the key points I think you mentioned was looking at other regulations and similarities. So you never want to do your work twice if there are similar requirements for regulations across the board. This is a really key step of looking at the horizon of all your regulations and making sure you've mapped out what has to be done and what needs to be created from a reporting standpoint, and looking at similarities and overlap between those. I think that's a really key point to pull out of all. There was a lot of information on this slide, and that was a key one I think we should point out.
That's a good point. That's a good point, Stephanie. Now we'll go into an update of regulations. Stephanie?
Thank you. Sorry, I didn't realize my slide was next. So Basel III, this is one of the regulations we'll talk about. It's an internationally agreed set of measures developed by the Basel Committee on banking supervision in response to the financial crisis we all know about from 2007 through 2009. The measures aim to strengthen the regulation, supervision, and risk management of banks. This is one of the bank regulations. And the Basel III standards are minimum requirements which will apply to internationally active banking institutions. Some history on the reform: the global regulatory framework, its original release was in 2011. The FNet stable funding ratio was in October of 2004. And then back in January of 2013, just to back up, was the liquidity ratio, or liquidity coverage ratio. And then recently in December of 2017, the finalization of the post-crisis reforms occurred. So in that December, the BCBS, which is the Basel Committee, released additional revisions to the Basel III framework. A key objective of the revisions incorporated into the framework was to reduce excessive variability of risk-weighted assets, or they're otherwise known as RWA. The revisions to this regulatory framework will help restore credibility in the calculation of RWA by 3 different things. And it's enhancing the robustness of risk sensitivity of the standardized approaches for credit risk and operational risk. The second is constraining the use of internally modeled approaches, having some standardization and not different types of models out there. And then the third and final is complementing the risk-weighted capital ratio with a finalized leverage ratio and a revised and robust capital floor. So those are the updates on Basel III. Melody, you have anything to add, or I can move on?
No, I don't think, Yeah, many companies are not really attuned to Basel III, except as it affects their banks. And that's at least fortunate for corporations because they didn't have to do a lot of implementation on that.
Just be aware of it.
Just be aware of it
one of
and how it impacts.
It was one of the ones we mentioned that was on the bottom of that chart. The black boxes of all the different regulations and the impact on corporates was on the lower end because it was indirect.
Right.
So moving on to Dodd-Frank. Dodd-Frank was created along with Basel III in response to that financial crisis. It was introduced by the Obama administration in 2010. Its aim was to introduce much stricter regulation onto the financial market. It was the most comprehensive overhaul of the financial regulatory system since the Great Depression and the Glass-Steagall Act. It included greater transparency into the use of derivatives, consumer protection reforms, improved oversight of credit rating agencies, and a consolidation of regulatory agencies into larger bodies with more authority. An example of this would be the Financial Stability Oversight Council. And then in June of 2017, so this past June, almost a year ago, President Trump's administration introduced the Financial Choice Act. The aim of this is to reduce many of the restrictions introduced by Dodd-Frank, which it has been argued are too constricting and have stifled the banking environment's ability to operate. Some of the key propositions included reducing the Fed's monitoring of banks designated as too big to fail, exempt banks with less than $10 billion in assets from the Volcker rule, restructure the Consumer Financial Protection Bureau and a multi-member commission with funding derived from Congress instead of the Fed, and bank stress tests conducted every 2 years instead of annually. These are all things to kind of make it less restrictive, but still provide what it was created to do.
And of course, there's FBAR, which continues to haunt corporations and will continue to do so. It has a history of delays. So the extension that they've done builds upon a series of deadline extensions that have been occurring for a number of years, eight prior extensions. And the previous deadline had called for corporate filings for individual signers on foreign accounts to be completed by April 2017, and that had changed to April 2018. It also allows for an automatic 6-month extension for both corporates and individuals, which is good. And for the filing for this year is supposed to be for all previous years, all the unified years from 2010 to 2017, if those have not been filed. The corporate filings now have to be completed in XML format rather than the Smart PDF they used to have or the batch file. Also in 2018, it's been verified that the cryptocurrency holdings fall under the FBAR jurisdiction. And FinCEN's voluntary disclosure program is ended this upcoming September. So the action that's required is that organizations should continue collecting FBAR data, plan for the deadline and filing, and ensure their processes comply with XML formatting requirements. And if you can't comply with them, you need to find either an outsource that can or a program that can assist you with that. Another one is SWIFT CSP, which many have already complied with. It's because of the constant threat of cybercrime. So cybercrime isn't going anywhere. It's here to stay, and it'll probably increase. In fact, it has been increasing each year. And they have evolving techniques. So the recent fraudulent activity that created the SWIFT CSP, which is the Customer Security Program, was not that the SWIFT network was hacked. It was that individual users' accounts and endpoints, access points, had been compromised. the SWIFT started the CSP to make it harder for criminals to access the SWIFT network through the user system. There's a number of mandatory controls that are required, that you're required to attest to, and then there are some not mandatory, voluntary controls, which they have said they may make mandatory in the future. By the way, therein lies a thing where you can anticipate. So you can always, ahead of time, if you have your game plan, anticipate if they were to implement that, what you might need to do. But if they did, you could do it quickly. But this is designed specifically to support the customers in a fight of cyber attacks. So the action, it requires you to comply with the security controls in the test. It requires organizations to self-attest, and your counterparties can view your attestation and you can view theirs. If they are not satisfied with your compliance, that you aren't complying with it, then they could opt to say, I don't need you as a counterparty, if they were concerned about it. Now, we don't think that's necessarily going to happen. I'm just saying that is a possibility if someone were not in compliance. So they attach the mandatory security controls, and they use what they call the KYC registry application to do this. It's online. It's required for every organization with a live 8-character BIC. The deadline was December 2017 to self-attest. In January, SWIFT reported that 89% of all customers attested their level of compliance with mandatory controls. And it's a really majority response because the organizations that successfully attested represent 99% of all PIN messages over the SWIFT network. So it's been an extremely positive response, which is good.
So Melody, just a little bit back on SWIFT. So what we're seeing here is, yes, a lot of SWIFT companies that have BICs are actually, attesting, which is a great thing. But this is one of those things that's it's a regulation that's going to become very required, just like KYC and other regulations down the pipeline, because it's a response to fraud, and fraud is typically the culprit that creates regulatory requirements, amongst other things like the financial crisis. But it's a great thing. We're seeing clients actually work on it. They're calling out and asking questions, getting more information, and really working on getting this attestation completed, especially if this is their main source of payments, if they're doing all their payments through a BIC. So this is very crucial to their environment, their internal environment and liquidity in the company.
That's a good comment, Stephanie. Whoops. Can you cover 385 for us?
I can. Hold on one second. Move. So for the 385, so this is section 385. Also, I'm hearing some background noise, and I don't know if everyone has muted their microphones on their computers. So if you could please do that, it'll allow everyone to hear us a little bit better as we're speaking. So for section 385, back to that. By the way of the 1969 Reform Act, Congress enacted Section 385 of the Internal Revenue Code. And this is to authorize Treasury to issue regulations to determine whether an instrument should be classified as debt or equity for federal tax purposes. There's some shortcomings we have in this policy due to the limitations of the original Section 385 framework. The IRS felt that a loose interpretation of how to classify certain debt and equity-related instruments led to tax evasion. So that's your shortcoming for this policy. And then some recent activity we've seen is that the U.S. government and the IRS have placed debt and equity classifications under increased scrutiny, especially in the context of inversions and other cross-border situations. On April 4th in 2016, there were some proposed changes. The United States Treasury and the IRS published proposed regulations under Section 385 of the Internal Revenue Code. On the 13th of October in 16, we had some final and temporary changes occur. The Department of Treasury issued final and temporary regulations for it, and overall the changes mark some of the most significant changes that the U.S. Treasury has issued in the past decades. Some simplification, tax simplification and deadline extensions that occurred in 2017 focus mainly on that tax simplification initiative introduced by President Trump's administration, which could impact the finality of 385 legislation altogether. So additionally, a 12-month deadline extension was applied for documentation regulations. Melody, do you have anything to add to 385 before we move on to the next slide? Melody, you may have muted yourself after my request.
You were right. I did. Yeah, I think that a lot of companies have already complied with this. In fact, some companies have gone to having fewer intercompany loans. It was certainly an onerous task to do all this because you had to have all these intercompany agreements, and they had to be like arm's length, and so there's a lot of documentation. Some companies elected to go through that, and some did not. They elected to eliminate some of the loans. But I think most people have gone through on the compliance now. There were some aspects that they did not implement, but they reserved the right to relook at some of those for a future implementation. So it's something to keep an eye out on in case it changes again.
Okay. I'll let you go ahead with the next slide for GDPR.
Okay, yeah. GDPR is really applicable, even though it's an EU and UK regulation. It's really applicable to any organization anywhere in the world that collects data within the EU and UK, regardless of where the company is located. It doesn't matter where you're located. If you have data on EU or UK citizens, you're impacted. So a significant portion of global businesses are impacted by the regulation. It changes the risk profile of practically all organizations with operations in the EU. So many organizations might have to undergo significant changes to the processes because you're required, you have to have a specific agreement of the individual to have the data. You have to have it encrypted. There's many different requirements that you have to meet to store personal data. And a person has the right to be forgotten. They can say they don't want any of their data out there. That's certainly difficult, particularly when you're talking about internet and internet businesses like an Amazon or something like that. It makes it pretty onerous to think of how you're going to comply with that. And it will often, for most companies, require systems changes, which never goes quickly. So this regulation goes into effect on May 25th this year. And at the point it becomes legally enforceable, organizations that don't comply can face strict fines and penalties. So there's a number of principles in it. So the first 5 principles, if you breach them, any one of them, you could be subject to a fine equaling the greater 4% of total revenue or 20 million euros. Breaches of the 6th and 7th principles would face fines of 2% of global revenues or 10 million euros. So, and individuals can sue organizations that cause damage to a breach of personal information. And this is personal information that can be used in combination. So someone over here stores an email address of an individual with the name, and someone over here stores a bank account with an individual, and those can be linked together, and then you have more that can be breached. So the way to get around this is first to conduct a data audit. You want to identify the scope of the data collected and stored by your organization as it relates to the UK and the EU, and map the current data processing workflow. You can identify then what your shortcomings are and compare your current data processing structure and controls against what they are requiring in order to identify any areas where your systems are going to need updating. You have to create a remediation roadmap, and actually the roadmap is not supposed to extend beyond May 25th, 2018, so if you haven't begun it, you could have an issue. And then you have to have implement your controls. So once they've been identified, your roadmap has been constructed, you have to begin the process of obtaining your data processing and storage infrastructure. The other thing is this is something that could continue on to other countries. You know, other countries may begin to look at having this type of a regulation, and that would require them doing that to other individuals from other countries. You need to monitor and refine it, of course, once you do it, because as changes are implemented, you have to continually monitor the effectiveness of your procedures. That means also when you have changes even in benefits programs where you might have to collect more data, okay, that's going to be impacted. So those are things that you have to keep aware of. Can we go to our third polling question here?
And while we're doing that, Melody, you said something that I was going to point out as well, and it's the fact that someone's always the leader in developing new processes or new regulations within countries, and there will be close followers, and other countries will follow much later. So putting this structure into place now just for the UK and European individuals is going to be very, very good for organizations as others follow close behind, because I do think we're going to see more and more regulations around personal identifiable information due to all the data breaches that we experience almost on a daily basis.
Yeah, that's a very good point, and I do see that this will probably expand further. I don't know how anyone, I don't know that it would happen here in the U.S., but I think there are many countries where it will. So let's see what we have. Have you begun developing a plan for implementing GDPR? We've got 39% that say they don't feel GDPR is applicable to us. I would assume those are domestic companies with only domestic vendors and only domestic customers.
It could also be companies that don't hold personal information. They may interact in the UK or Europe, but they don't have personal identifiable information on particular individuals.
That could be too, yes. And then let's see, we have 18% no, but we need to start, and 24% are in the early stages. Almost 10% are nearly finished, and 10% are finished. So 20% are very close to being completely done, and 38% about it doesn't apply to. So you're dealing with about 42%, 42% that still have more to do.
And that deadline's fast approaching.
It is. Hopefully they'll be lax and allow a little bit of a leeway time, I would hope. They could follow the FBAR example.
Yes.
So let's talk about how it affects Strategic Treasure. We're not a big company, but we do have clients that have individuals in other countries and that we work with on various projects, so we're impacted. And that has meant that we have to implement new procedures on how individuals' data is captured and maintained in the system. So, you know, it meant that we had to research. So we had several analysts conducting research and developing documentation and recommended processes. And then we had internal discussions. So the entire team to meet to discuss the impact that these changes would have on current processes and a prospective timeline. And third is implementation. So we have to go through this too, and we're not a multinational company. We're a U.S. company with clients that are multinational. Do you have anything else? Any other thoughts on this?
Not thoughts. I think this is a very simplistic example for everyone that's implementing or starting to implement. Us having clients that are international or multinational with individual information where we're collecting it on their behalf or they're providing it to us puts us under that scope of needing to comply with GDPR. And from an overall project step standpoint, your research, your meeting, your planning, and then the implementation of that plan, those are the high-level steps. The details underneath it may be much more intricate and detailed in order to get to your implementation and final state of being compliant. So just overall, this is the high-level steps. There's a lot of implementation and discussion and steps that you have to take to become compliant underneath.
Yes, I agree. So let's talk about our final thoughts, our key takeaways. One, I would say regulatory concerns and pressures are escalating. So both corporate and bank practitioners have significant concerns regarding the current state of compliance, expectations, and costs. Now, one thing to keep in mind is as technology is increasing its capability, so they now have people who can hack 6-digit PINs where they could do 4 digits before. So as technology increases in its capability, it means that there is higher incidence or higher risk for issues with personal data, issues with regulation, issue with cyber fraud, and I think we will see additional regulation in order to address some of these things that occur, and that's I think bodes for the future an increasing amount of regulation. There's a lot of uncertainty in the future. The current administration's approach to compliance is one of lessened controls rather than stricter requirements, but it really remains to be seen what the scope of the change will be and whether or not, that is a positive or negative. So Stephanie, do you want to address the other 2 points?
Yes, definitely. Sorry, I had you on mute again. So the other 2 points is that we wanted to talk about was just staying informed. So that's kind of been something we brought up throughout this webinar today, is keeping abreast of changes that are going on. And given our current environment, it's really vital to the livelihood of Treasury to stay informed on these upcoming changes, any proposed changes that are currently in the works, and new developments. So you don't get surprised or it would have a result in some unexpected change or challenge, or you wouldn't be compliant and you're scrambling at the end to become compliant. So just staying informed overall through webinars, through research online, through any type of white papers that are out there, just keeping abreast of things that are out there. And then that leads into just my next, that proactive versus reactive approach or your game plan. It's always important to be proactive than reactive. Developing a standard procedure for tracking and responding to any new compliance requirements. It's going to help all Treasury departments streamline their response to get that quicker result and be more effective in implementation of new controls and procedures. Having that plan in place, like we talked before, allows you to be able to easily identify overlap between regulations so that you're doing less work instead of more work. and identifying any new items that you have to do. So that's always a key control there. And I just want to remind everyone the chat box is still open if anyone has any questions. And I'll hand it over to Melody for any last thoughts before we give it to Meredith.
Thank you, Stephanie. And I think that she nails it, that there, I mean, the combination of the uncertainty and the increasing risks that are happening speak to having a proactive approach that you can address it. And I think that it also is a good reflection on Treasury to be strategically ahead. So I think we're ready for questions, if there are any.
So just want to go ahead and thank everyone for attending today's webinar. We will stay online for a few more minutes if there's any questions. As a reminder, I will send out the credit form, a copy of the deck, and the recording in the next 7 business days. And then as always, please continue to check out our website. We have plenty of webinars throughout the year, so we hope to see you in attendance in the future. So again, if you have any questions, let us know. But thank you so much for attending today.